Good morning. Welcome to the board meeting of the Teachers Retirement Board for January 5th, 2023. I'll start by calling the roll. Brian Berge,
Brian Berge for Mayor Eric Adams, present.
Thomas Brown.
Here, good morning, Patricia.
Good morning. Russell Buckley,
Here on behalf of the Panel for Education Policy Chair, Dr. Angela Green.
Allison Hirsch,
Allison Hirsch here, representing Controller Brad Lander. I will have to step out at noon, at which point John Dorsa, my alternate, will take over for me.
thank you. David Kazansky,
Present.
Deborah Penny.
Good morning, I am here.
Good morning. So we have a quorum and I'll turn it over to the chair.
Okay, thank you. Happy New Year, everyone. Wishing a happy and a healthy one for sure. I apologize for the last minute notice of this meeting being virtual, but as I was hearing of more and more people getting ill, I just thought it was safer for everyone to remain where they were. And we will meet again next month at this time, but thank you. So we are ready. We're going to start with, we are in public agenda with the passport fund. So we'll start with Michael Fulvio.
Thanks, Madam Chair. Good morning, everyone. Happy New Year and wishing you all a happy and healthy 2023. I'm going to share my screen and then turn it over to my colleague, Amanda Janus, to review November's performance.
Thanks, Mike. So good news is that the month of November was another positive month after following a pretty positive result for the month of October as well. For the month of November, there were really two things that drove that result. One being weaker than expected inflation CPI numbers, and the second being some signaling from the Fed of slowing the pace of rate hikes, both of which were met with positive reaction from the market. And so really those two announcements correlate to the two strongest trading days of the month of November and resulted here in positive results for the month. In particular, the strongest results came from your non-US equity investments, which were up double digits for the month of November, but really across the board, positive results. The one fund that outperformed its benchmark for the month was the balanced fund. And really even looking out over the trailing 3 months after having both a positive October and November, we are looking at positive absolute returns for the trailing 3-month period as of the end of November. So overall, encouraging numbers. Your diversified equity fund, you can see at the top of the page there, up about 6.5% for the month. In particular, the international component of that fund being the key driver of results there. And down the bottom of the page, best performer being the International Equity Index, which was up over 13% for the month. Any particular questions in terms of November results?
Any questions for Amanda? Yes, we're good. Happy to see all those positive results there for the month. So thank you. Okay, so I guess we are on to the December 2022.
Yes, we are. I would like to continue the theme of I'd like to continue the theme of a positive results. However, December kind of ended consistent with that. Yeah, December's performance was actually consistent with the entire year's performance, which is was quite negative. Coupled with central banks battle against inflation, we had COVID restriction in China and also the war in Ukraine. That sort of led to not so great performance for the end of the year. However, on the bright side, we can say that we did have some positive results as a fiscal year to date, December. But for the month of December, we saw that the global market composite benchmark was down by 18.5% for the year and 4.6% for the month. On the balanced fund benchmark, we saw that it was down by 9.06% for the year and down by just over 1% for the month as well. The weakest performer across the board there was a sustainable equity fund benchmark, which is down about 30% for both strategies for the year, and down by roughly 6% and 7.6% for the month. And perhaps the strongest performer, no surprise in there, was the actual balance benchmark. Actually, the strongest performer there for the year was actually the international composite benchmark, which is down 16.67% for the year and down 0.26% for the month, but up 3.7% fiscal year to date. But yes, as I was saying before, that the performance for the month was consistent with the year's performance, which is down across the board. Any questions there?
Thank you, Devin. Any questions for Devin? Okay. Why is there, Liz is inviting, Liz, why is that executive session thing up?
No, that should,
Just hit on now.
yeah,
Just-
just hit not now.
Oh, that's
Oh,
me.
telling
I'll
me.
close it, I'll close
David,
this.
sorry.
I forgot.
I
Telling
took
me
care
to
of
hit
it. I took care of it.
Okay. Does anyone have anything else for the Passport Funds public agenda? Okay. Then we are off to the public agenda for the pension fund, and we start with the third quarter risk presentation. And we have, where is he?
Hi, good morning.
Oh, there we go. Ed Berman from Bureau of Asset Management. Good morning, Ed.
Good morning, how are you? Yeah, and we're still talking about September month's end, the quarter end. So a little belated, a lot of things happened in the market, but let's just jump straight into it. Can we have the presentation on the screen, please?
I'm pulling it up, just 1 second. Can folks see?
Yes. Can we have the next page, please? Thank you. So for this quarter, we will follow the same structure of the risk presentation. There will be 3 parts altogether. Page 1 will give you a top-level view of the portfolio risks and the relationship between the portfolio and the strategic benchmark. Page 2 will provide a more granular breakdown of risks to give you a sense of risk concentrations at the individual asset class level. And page 3 will focus on the forward-looking projections, and that's where we'll show you some of the new analysis that we developed at BAM as we expand our risk framework. So let's start with the plan level overview. And you can see on the page that the total risk at the end of the quarter stood at 12%. It's an increase of about 0.5% from the previous quarter. It's a number in the lower right corner of the table. It's highlighted in bold font. And just to remind you that this number represents the expected return of the portfolio over the next 12 months, meaning that we project that the gains or losses of your portfolio should be within 12%. And it also means that there's an about 15% probability that the gains will be larger than 12%, and also about a 15% probability that the losses may exceed minus 12%. But what does this number mean? What is the intuition behind this number? Is it something we should worry about? Is it a good outcome? Is it consistent with the investment process? Broadly speaking, the level of risk is determined by 2 main factors: by markets and by the portfolio construction process. So the main risk decision in the portfolio construction process is to establish the stock bond split. Historically, equities deliver the best returns, but also it comes at the cost of high level of risk. We capture this first step in the process by the market portfolio in the table, column 1 on the left. It is a simple 60-40 blend of the MSCI all countries and Barclays USAC, which is a broad measure of the domestic fixed income market. The next step of the process is to determine asset allocation within each category, where we establish the ranges for US equities, core fixed income, and other asset classes. These decisions are reflected in the strategic benchmark, where the market portfolio is further split into 11 components, as reflected at the bottom of the page. The exposures for the policy benchmarks are captured in the column 2 in the middle of the table. And the final step of the portfolio construction process is to fill out the manager selection process and the ongoing portfolio rebalancing, any cash flows. So this process is captured in column 3, which is your actual portfolio. So by applying this framework, we can get a better sense over the risk levels and what drove the changes. So let's start with the market portfolio. That is the 60-40 blend. This portfolio will be the baseline for our analysis. There are 3 main dimensions of risk that we take in this portfolio: equities, interest rate, and credit. These risk dimensions are shown at the top of the table under portfolio construction. So equity exposure is captured by equity allocation. It's the first row of the table. It is obviously 60% by construction. The next dimension of risk is interest rate or time value of money. The best way to measure exposure to interest rates is through duration of the portfolio. So what does this number mean? Simply put, it's a scaling factor that translates interest rate moves into portfolio's market value. The magnitude of the interest rate exposure is shown in the next line, with the rates duration equal to 2.5 years. It simply means that a 1% drop in interest rates translates into a 2.5% gain for the portfolio. You can notice that the duration of the portfolio came down slightly for this quarter. This is a direct result of an increase in interest rates as driven by the Federal Reserve policy. The final dimension of risk is credit spread, which is a measure of the default risk. Only the bonds issued by private borrowers have exposure to credit risk. So for this reason, only about 40% of the Barclays AG has exposure to credit risk, since 60% of index are treasuries and agency securities. Much like the above, the exposure to credit spread is measured by spread duration, which is just a multiplier to translate spread changes into market portfolio value. So the credit spread duration of 1.5 means that a 1% decline in credit spreads translates into a 1.5% gain for the portfolio. So how did this portfolio construction translate into risk measures? You can see it at the bottom of the table under portfolio risks. We present 2 measures of risk here. Let's start with the total risk, which stands at 11.6% at the end of Q3. So it is basically just an expected 12 months return for the portfolio with the usual disclaimer. It's 15% probability of more or 15% probability of less. You can notice that the total risk for the market portfolio increased this quarter by 0.5%. This is a direct result of volatility in the markets as we'll go through this historically extraordinary period. At the end of September, the VIX index, a measure of equity volatility, closed at the level over 30 points versus the pre-COVID average of 18. The action was even more extreme in the fixed income markets. At the end of September, the MOVE index, which is a measure of fixed income vol, closed at about 160, close to the highest historical level outside of the global financial crisis, as compared to the pre-COVID average of around 60. So the total risk will give you a measure of the portfolio's future expected performance over the next year or so. The other risk measure we show here is more a short-term measure, and that is the beta to the S&P 500. It's a measure of how the portfolio will move on average when the overall stock market increases or decreases. So the beta of the market portfolio shown at the bottom of the table stands at 0.57. It's almost unchanged from the previous quarter. It's interesting to note that the beta is actually smaller than the equity allocation of 0.6. The reason for this is the allocation to fixed income and international equities. The decline of beta versus equity allocation is a result of diversification in the portfolio. So now let's move from the market portfolio, which is our baseline for our analysis, to the policy benchmark, which captures the asset allocation decisions. You can see it in the column 2 of the table. You will notice that the strategic is running at a slightly higher equity allocation, but with broadly comparable rates and credit exposure. A drop in the rates duration versus the market portfolio comes mostly from the allocation to high yield, which tends to be of a shorter maturity. A small decline in spread duration comes from the allocation to TIPS, as they have no credit risk being government bonds. So how did the risk levels of policy benchmark compare to the market portfolio? It held quite well. As you can see at the bottom of column 2, the total risk level remains almost unchanged, despite a higher allocation to equity. This is a good outcome. We expect better returns from asset allocation, not an increase in risk. So I take it as a positive. So finally, let us consider the portfolio itself, which is shown in the column 3. You can see that the portfolio is closely aligned with this benchmark, but let's go over the small differences. There's a small change in equity allocation for this quarter, which I don't really see as material, and we'll see more details on the next page. You will also notice that there's a small duration overweight versus the strategic benchmark. While the portfolio is managed flat to benchmark on the rates exposure, the small overweight comes from the ETI allocation, which brings exposure to the long-dated mortgages, therefore an increase in duration. So how does this translate into risk measures? You can see them at the bottom of the table on the right. Again, the risk measures are broadly in line with the policy benchmark, but we should go over some differences. Let's start with the total risk, which is ranked at about 0.6% higher than the benchmark, a trend similar to the previous quarter. This increase in risk is driven primarily by the allocation to the private markets, mostly the private equity allocation, which is mapped against the Russell 3000. So it's not surprising that the beta to the S&P is also slightly higher than the strategic benchmark. And related to this is the third measure we haven't talked about so far, the active risk. Similar to total risk measure, active risk is a forward-looking assessment of the expected excess returns of the benchmark. So the active risk of 2.1% means that we expect the excess returns of the portfolio over the next 12 months to be within a 2.1% range, with the usual disclaimer, 15% probability more and 15% probability of bigger losses. Almost all of active risk is driven by the allocation to private equity. Out of the total 2.1% of active risk, about 1.5% comes straight from the US buyout strategies. Active risk increased this quarter by about 0.3%, mostly driven by the market factors, but about 3/4 of it was due to the impact of markets on the private equity strategies. And finally, I want to draw your attention to the chart on the right-hand side of the page. Here you can see the evolution of risk over the past 12 months for the portfolio. Chart 1 shows the time series of the total risk, and you can see that the relationships we've been discussing today have been stable over the time. You can also notice how the overall risk level declined slightly by the end of the year, end of the previous year, 2021, and then started to trend higher from January of 21. This is driven entirely by the market volatility. And the similar trend is noticeable for the active risk chart at the bottom of the page. So it's trend slightly higher from the low of 1.5% in December. Again, it's the impact of market fall. I'll pause here for a second if there are any questions for the total portfolio level. Otherwise, we'll move to the next page.
Chair, if I may.
Yes, go ahead, Russell.
Thank you. Hi, Ed. This is Russell. I wanted to ask a couple clarifying questions just to make sure that I'm understanding all this information correctly. When you say there's a 15% chance above or below relative to the 2.1% active risk, but I think it was also for the total risk as well, you're talking about one standard deviation away from the mean, essentially?
Correct. That's exactly
so
what it is.
Excluding the second and third standard deviation outside of what we would expect.
Well,
or rather measuring sort of the median and saying it's going to fall within that 68% give or take, of a normal standard deviation graph?
Well, this is, we use the measure of volatility to assess risk, and the volatility is a one standard deviation move. Right, assuming normal distribution, obviously two standard deviation move will be just a multiplier from this level.
Okay.
But then it
And
gets more complicated from there, right? Basically, what is
yeah,
tail risk?
yeah,
There are more dimensions to risk management, and I'll be more than happy to discuss them. It may be a little too dense for this meeting. It will take more than half hour, but more than happy to discuss.
understood. I'm trying to see if I can at least capture the high level points, make sure that I'm understanding the content correctly.
You're
I guess-
absolutely right. This is just a one standard deviation move. This is what you expect in like normal day-to-day markets. One standard deviation move happens several times a month. Most of the losses actually happened in the wings of the distribution. So normally we're more concerned with the tail risk.
Got it. Do we ever talk about tail risk or?
I'll be more than interested to have a broad conversation what the trustees would like to see in this presentation. And actually very much open to your suggestions and would welcome a chance to have this discussion.
Okay.
But that's
Yeah, I think
definitely something I would like to pursue.
before you move on, I think when I look at these the line graphs, I appreciate the detailed look in the last year or so. I would be curious maybe during the next presentation to see them over a longer period of time, maybe like 60 months or even like 120 months. I think I'm just trying to understand the historical context of these numbers, and that might help me better understand. I don't know if other trustees feel the same.
Sure, we can definitely show this information. Just one word of caution, the portfolio turned on significantly over this period of time, right?
Yeah, and please use your discretion, of course, in determining what an appropriate time period would be. I think I might need more than a year to like fully grasp the context, to put the year in context without 2022, which was an extraordinary year in some respects.
Yes. We can definitely provide more information, but I would also love to have a chance to have a broader discussion of the information that you would like to see in this presentation. There's a lot of different risk measures, and assessing the risk exposure of such a complex portfolio is obviously a multidimensional task.
Agreed. Thank you.
Okay, should we move to the next page?
I think so. Great. Thank you.
So here we take a look at what's happening inside the portfolio. So I'll review the exposures in more details at the asset class level, and we'll also try to see how the allocations contribute to the performance. First of all, let's focus on column 1, where we show the asset class allocations and the tilts against the strategic benchmark. We show here the allocations without parking place adjustments. So it's the actual allocations shown against the strategic benchmark. You can see that the public allocations are closely aligned with the benchmark, but there's slight differences in the private markets. Notably, private equity allocation exhibits a slight overweight of about 1.8%, whereas the other private allocations are running slightly below target. Hope there are no surprises here. Next, we focus on column 2, where we show the total risk level at each asset class level and the contribution of the portfolio total. The same information is actually shown in the chart at the bottom of the page, which may be a little bit easier to follow. And here we show allocations in blue and risk contributions in orange. Several observations have been made about this chart. First of all, you may notice that equity makes a disproportionately high contribution to the total risk level. The allocation that punch well above their weight are the US equity and private equity, also primarily domestic. You can also notice that the fixed income provides a useful balance for the portfolio to compensate for the high risk level of equities. Core fixed income and tips have almost negligible contribution to risk, despite having a material market value exposure. This type of risk distribution is typical of a multi-asset portfolio and is completely in line with the investment process. I also want to draw your attention to column 3, which is active risk at the asset class level. Here we assess the active risk for each asset class against its own benchmark. Several observations stand out. First of all, active risk of public markets is well contained, about 1% for equities and very small for fixed income. There's slightly higher levels of active risk for developed ex-US, which is consistent with allocation to active managers. And I was told not to mention specific managers in public session, but some of your managers running active risk of up to 18%. Active risk for US public equities is much smaller, which reflects a large use of passive managers. There was no material change this quarter to the active risk for public managers. If anything, active risk came down slightly, but it's not that material. It's about a 10 basis point decline. Active risk for fixed income public managers remained almost unchanged from the previous quarter. Finally, we see a large level of active risk under alternatives, which is not surprising given the idiosyncratic nature of this asset class. Specifically for private equity benchmark against the Russell 3000, active risk stands at 18.3%, which is an increase from 15% in the previous quarter. This high level of active risk is intuitively correct, as we saw significant decoupling in performance between the private and public markets. Most of active risk for private equity comes from the allocation to US buyout strategies, both large and small. At the system level, the active risk of 2.1%, you can see this number at the top of the table, is driven almost entirely by private allocation. Specifically, the private equity strategies contribute 3/4 of the total risk level, primarily driven by US buyout managers. So what does all of it means for performance? Remember that we defined risk in terms of the ability of the portfolio to generate returns, be it positive or negative. So let's turn to column 4, where we show the 12-month returns for each asset class. The first observation is that every single node on the public markets is colored red. This reflects the historically difficult markets that we've been experiencing. Both equity and fixed income markets sold off, which delivered the worst performance for the 60/40 portfolio going back almost 100 years. And the losses for some asset classes exceed our risk forecast, especially where we rely on active managers. I'd like to point out developed ex-US, where the loss of minus 31% significantly exceeded our risk forecast of 20%. The same is true about the excess return of minus 5.6%, being far more than the active risk of 2.7%. The returns for mostly passive US equity strategies are comparable to the risk forecast. The fixed income market specifically went through a highly unusual period as the rates increased at a very historically fast pace. The first half of this year delivered the worst treasuries returns since the 18th century, and we'll clearly see it in the returns on the public side. The absolute returns exceeded the risk forecast by a wide margin, but more importantly, the excess returns are reasonably close to the active risk forecast. The alternatives, on the other hand, delivered performance that provided a helpful diversifier to the public markets. Private equity and private credit returns are broadly in line with the risk forecast. A real standout here is the stellar performance of private real estate, which exceeded our risk forecast by a factor of almost 2. I'll pause here. Any questions at the asset class level? If not, can we have the next page, please?
I think you can go on it. Thank you.
Thank you. So you'll notice that this page looks different from the previous quarter. Here we present our forward-looking projections for your portfolio. We obviously do not know what the future will bring. So instead, we're focusing on the major macroeconomic factors that may impact the performance of your portfolio. And we're trying to identify which factors we need to watch out to understand the future performance. Fundamentally, there are 3 groups of macro factors that impact the economy, markets, and by extension, the performance of your portfolio. Let's start with the equity markets, which is obviously the most important component of risk and returns, as we just discussed. Equities are traded in almost every country of the world, but three most important markets are the United States, the European Union, and China, or more broadly, the emerging markets. Together, these three centers captured about 2/3 of the global equity capitalization, with the USA being 41%. These three markets identified in the first three lines of this table by the indices, the S&P 500, the Euro Stocks, and MSCIM. So you see it on the first three lines of the table. The second bucket is reserved for rates. That is the cost of capital. We highlight three rates here that's most important for the portfolio, lines 4 to 6. The 2-year Treasury note is the best proxy for the Federal Reserve policy rate, since it captures both the rate hikes and the market expectation for the future policy. The 10-year Treasury note is representative of the broad economy, as it is used as a benchmark for mortgages and investment-grade debt. Finally, the euro-dollar exchange rate stands for the strength of the dollar in the international markets, since the dollar has the unique role in the global hierarchy of currencies. And finally, the third bucket, commodities, captures the dimensions of the real economy, which produces goods and services. Copper, in line 7, stands for the strength of the global manufacturing, since copper prices correlate highly with the industrial output. Oil, line 8, stands for demand for energy, which is a critical component of any economical activity or transportation. And finally, inflation on line 9, which is the macro factor that doesn't need any introduction. It dominated our lives in the past year. The next step in our analysis is to identify how much the prices of these factors may change in the future. So there's obviously no way for us to forecast these levels, but we can use our risk models to estimate a market implied move. In this case, we're asking a question: what will be the worst monthly market move to happen over the next year? You can see the results of these calculations in the next column of the table on the market move. These monthly market moves are estimated to have an 8% probability of occurring, which corresponds to roughly once a year. I want to repeat one more time. These are not market forecasts. All these market moves have the same likelihood that may roughly correspond to a monthly move for the next year. I want to pause here for a moment to appreciate the magnitude of these market shifts. These are truly big numbers across all three buckets. Notice that we're not forecasting the direction of the move. It can be either up and down. For example, our model sees a material likelihood that the equity markets may experience a 30% melt up or melt down over the next year. Also notice that among the three equity indices, the EM has the lowest volatility and therefore the lowest risk. Somewhat unusually, the risk of European market exceeded those of the US, which reflects a difficult market macroeconomic environment for the European economies. The numbers in the rates buckets are also unusually large. A monthly move of 160 basis points for the 2-year Treasury note would have been unthinkable just a couple of years ago. Similarly, a 10% move for the euro-dollar FX rate is shockingly big in the context of the past 20 years. Finally, the commodities bucket. A 57% move for oil means that the oil prices can move from the current level of $77 within the range of 34 to 120. Intuitively, this feels consistent with the market over the past couple of years, when the prices moved from being negative to 140, I think was the high. Similarly, the monthly change for the inflation, almost 3%, indicates how uncertain the current macro environment is. So what does it mean for your portfolio? The results are captured in the next two columns, both the portfolio and the strategic benchmark. We split the results into two categories: risk on, colored green, represents the rally in the market, and risk off, colored red, represents the sell-off. So altogether, we show you 18 possible outcomes for your portfolio and 18 outcomes for the benchmark. I'm not going to read the numbers, instead focusing on the main takeaway, with the goal of identifying the factors that have an outsized impact on your portfolio. Let's start with equities, lines 1 through 3 in the table. I'll be focusing on the risk on column, but the conclusions will be similar to the risk off. You can see that among the 3 markets, the US equities have by far the largest impact on the portfolio. I find this to be a positive result. Whereas the global economy is facing multiple headwinds and likely heading towards a recession, the United States stands as a strong economy with a better potential to deliver stronger performance. China and Europe face their own set of challenges, different in each case, but on a relative basis, your portfolio is somewhat insulated from the spillover effects of these markets. Next, let us look at the rates bucket. I find these results to be most interesting. The portfolio is not actually that much sensitive to the federal fund policy. For a 160 basis point decline in the 2-year rate, our model projects about a 1% increase in the portfolio NAV. The move is slightly larger for the 10-year, close to 2%, but still not that much significant. But look at the move for the dollar exchange rate. Clearly, the US dollar has an outside impact on the performance. A decline in the dollar exchange rate of 10% will increase the value of your portfolio, but 5.5%. And finally, the commodities bucket. In this case, the price of copper has a strong impact on the portfolio. Just to remind you that we use copper prices as a proxy for the overall economic activity, since the demand for copper is highly correlated with the GDP growth. And impact of copper price is quite high, even larger than the dollar. A rally in the copper price of 35% will be hugely positive as the portfolio gains 6.5%. Oil prices have a similarly large impact on the portfolio, but copper clearly is a dominant contributor. Related to that is the impact of inflation. It is probably not surprising that inflation is one of the most important factors for the performance of your portfolio. Maybe somewhat counterintuitive, but the portfolio returns are positive in an environment of rising inflation. The same thing applies to all commodities, as the portfolio benefits from the rising commodity prices. And you can notice that your portfolio gains almost twice the rate of inflation increase. So let me summarize the main takeaways from the forward-looking projections. First, the main macroeconomic factors that impact your portfolio are the domestic equities. The portfolio has a lower sensitivity to the European and Chinese stock markets. The strength of US dollar exchange rate, weakening of the dollar will have a beneficial impact on the performance, and inflation. The rise in nominal inflation will lead to a positive return. I find this framework useful to understand the main risks and exposure in your portfolio and to connect the expected performance with the headline news that we read every day. 2, there's little diversification in the portfolio across the asset classes. You can see it in the chart at the bottom of the page, where we show the performance of individual asset classes for the highlighted scenarios. Almost all asset classes perform in the same direction. The largest risk concentration in the portfolio comes from the US public and private equity allocation. Interestingly, that the core fixed income allocation doesn't have any material impact on the performance under either stress test. And 3, the portfolio outperforms the benchmark under every single stress test. That is true for the risk on scenarios where the outperformance is desirable, but unfortunately also true for the risk off scenario, where the portfolio performs the same or worse than the benchmark. And this conclusion is consistent with the observation we made in the first 2 pages. So I'll stop here and open for any questions.
Thank you, Ed. Any questions for Ed?
Deb, if I could ask one more.
Sure, Russell.
Thank you. I'm looking at the risk on and risk off columns here, and in almost every single one, Ed, TRS is outside the policy benchmark. So if it's on the risk on, TRS is above the policy benchmark and everything except for the European stock market. And then same thing for the risk off, TRS is always below the policy benchmark. Is that internal leverage? What's causing that?
I wouldn't call it leverage. It's the risk level of the portfolio is slightly above the benchmark. we saw it on the previous page, on page 1. We saw there's an active risk component, right? So ideally would like to see the risk on outperformance and the risk off to cushion the blow, right? So that we ideally, it's not that easy to achieve for such a well-diversified, a huge portfolio. But I think the purpose of this table to show that given the assumptions we put in these stress tests, we do not actually see this desired outcome. That's exactly the point of this stress test.
Okay, thank you.
I think it may be a good gateway as we are moving towards the strategic asset allocation in the next few months, maybe a good point of discussion, which is exactly the point why we show these results here.
Any other questions for Ed? No? Okay, thank you so much, Ed. That was a very interesting presentation. Thank you.
Thank you.
Just one, want to jump in here and reiterate something that Ed mentioned on behalf of BAM, which is I know he has been eager since coming on board in July to have a meeting with trustees to get a better sense of what would be helpful and effective in a risk presentation. And that is something that is on the table that we're going to move forward on in the next month or so. So I just want to flag that.
Great, thank you. Okay, does anyone else have anything for public agenda? Hearing none. So do I have a motion to go into executive session?
So moved.
Thank you, Mr. Brown. Do I hear a second?
Second.
Thank you, Mr. Kazansky. Any questions? All those in favor of moving into executive session, please say aye.
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 Any opposed? Any abstentions? Okay, we're moving to executive session. All right, we are back in public session. Susan Stang, would you please report out?
Certainly. In executive session, we received a preliminary performance review for the pension fund. We discussed the excluded company list. We received a presentation from MSCI. We received annual implementation plans for private equity and real estate. Consensus was reached on both.
Thank you very much. Does anyone have anything else? Okay, hearing none. That's not Brian. It's you. Okay. Do I hear a motion to adjourn?
So moved.
Thank you, Mr. Kazansky. Do I hear a second?
Second.
Thank you, Mr. Brown. Any discussion? All those in favor, please say aye.
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 Any opposed? Any abstentions? Okay, we stand adjourned.
We have the
Happy and a healthy new year. For the trustees, please don't leave. We have attorney-client